Interest rates may sound like a boring economic term, but they quietly shape almost every part of your financial life. From stock prices and bond values to real estate, savings accounts, and even cryptocurrency sentiment, rising interest rates can dramatically change how your portfolio performs. In today's video, we'll break down what rising interest rates really mean, why central banks raise them, and most importantly, how they affect your investments, both positively and negatively. Let's start with why interest rates rise in the first place. Central banks increase interest rates primarily to control inflation. When inflation rises too quickly, money loses its purchasing power, and everyday goods become more expensive. By raising interest rates, borrowing becomes more expensive, spending slows down, and inflation gradually cools. While this policy helps stabilize the economy, it also sends shockwaves through financial markets. One of the most immediate impacts of rising interest rates is felt in the stock market. When rates go up, companies face higher borrowing costs. Loans for expansion, research, hiring, or acquisitions become more expensive. This can reduce profit margins, especially for growth-focused companies that rely heavily on cheap capital. As a result, investors often reassess company valuations, leading to market volatility or even sharp corrections. Growth stocks are typically the most sensitive to rising interest rates. These companies are valued based on future earnings, sometimes years into the future. When interest rates rise, the present value of those future earnings decreases. That's why tech stocks and high-growth sectors often struggle during rate hike cycles, even if their long-term business outlook remains strong. On the other hand, value stocks tend to perform relatively better when interest rates rise. These are companies with stable earnings, strong cash flows, and established business models. Since their valuations are less dependent on distant future growth, they're generally less affected by higher discount rates. This is why sectors like financials, energy, and consumer staples often gain attention during rising rate environments. Banks and financial institutions can actually benefit from higher interest rates. As rates rise, banks may earn more from the difference between what they pay on deposits and what they earn on loans. This wider margin can improve profitability. However, if rates rise too quickly and slow economic growth, even financial stocks can eventually face pressure. Now let's talk about bonds, which are directly tied to interest rates. Bond prices and interest rates move in opposite directions. When interest rates rise, existing bonds with lower interest payments become less attractive, causing their prices to fall. This can lead to losses in bond-heavy portfolios, especially long-term bonds, which are more sensitive to rate changes. Short-term bonds tend to be less affected because they mature sooner, allowing investors to reinvest at higher rates more quickly. So, what does all this mean for your portfolio? Diversification, time horizon, and disciplined decision-making become more important than ever. Rising interest rates are not inherently bad. They reward patience, strategy, and understanding. Instead of fearing rate hikes, use them to strengthen your long-term investment approach.